There you go.
Okay, well, it is just after 2. I forget if there's one more that might join us, but that's fine if they do. Welcome, everyone. I'm Vernon Wright from Christ Home, Chief Development Officer. And we have several of you from the retirement community that are joining us. George Zoflik is hosting the meeting on Zoom for us. Thank you, George. As he mentioned earlier, in case you didn't hear, we are recording this because we know there was some folks who wanted to hear the presentation who weren't able to get on here at 2 o'clock. So we will be able to make it available to them and even to you if you're interested in hearing some of it again through a link. I think it's to YouTube. So thank you, George. We have Tom Moore and Stephen Burns with us from Glenmede. Glenmede is the investment firm that we have been working with, I think, close to 6 years, 5 or 6 years. And they have done a terrific job working with Christ Home and helping us with our investment strategies of our assets and helping them to grow. They're there to help guide us through the speed bumps and the ups and downs, the dips that happen. And they're a calm hand at the stern or at the wheel, which we appreciate. We'll probably start off here with Steve. He's kind of going to provide for us one of the things that I think we all like to get updated on, and that is what's going on in Wall Street and Main Street, and things that you hear about every day in the news, things that you certainly are familiar with and are concerned with. But this is something he spends many hours every day reviewing and working with the team on. So we'll turn it over to Steve. Steve, you can introduce yourself, your position at the firm, and then we'll come back to Tom later on in the program. Welcome, Steve.
Great. Thanks, Vernon. Thanks, everyone, for joining us here today. As Vernon mentioned, I work with Glenmede. We're an investment management firm. My role at Glenmede is as a senior portfolio manager, working on our dedicated endowment and foundation group. So I only work with nonprofits similar to Christ Home, investing assets really with the purpose of growing them to support the spending needs plus inflation of the organizations that we work with. So we work on things like asset allocation analysis. What's the right allocation between equities, fixed income, alternative assets, and then really just trying to grow the portfolio in a diversified manner over the long term. What I'm going to do is spend about 15 minutes or so, and I have some slides to share. Just as Vernon mentioned, reviewing the current landscape from the economy and the markets perspective, looking backwards at sort of where we've come. It's certainly been an interesting 16 to 18 months in our lives, but in the markets as well. But really also focusing on what we see in the next year ahead, because really I think that's what's important. That's what everyone wants to sort of understand. And then Tom, who I work with, will introduce himself, and they're going to talk about some some plan giving and tax planning things that people should be considering into year end, given that there's a lot of certainly always a lot of conversation going on in Washington and potentially a changing of the rules as we progress moving forward. So let me just share my screen here. And what I would say is that I'll pause a few times during this presentation. I would like you all to be able to ask questions. If there's anything that's unclear, if there's anything specifically you want to get out of the presentation today, but I'll also pause at the end too to see if there's anything else that I can clarify. But as Vernon mentioned, both Tom and I work with Glenmede. Just a quick background, 30 seconds on Glenmede. Glenmede was founded over 60 years ago to serve as the corporate fiduciary and investment manager of the Pew family's money, which has now become the Pew Charitable Trusts. So we were actually founded, which is unique in the investment industry, to serve and to work with nonprofits. Over the years, after it became clear that some of the sophisticated strategies that we were utilizing in the Pew Charitable Trust could be beneficial to other clients, we started opening our doors and bringing in other endowment foundation clients, private clients, as well as large family offices as well. To where we sit today, as of the end of the middle of this year, end of September, with about $44 billion in assets under management. About a quarter of that is with endowments and foundations, similar to Christ's Home. And certainly, the other sort of thing to understand about Glenmede is that we're private. We're really focused on being a good fiduciary, serving our clients, and we're solely focused on investment management and advisory services. So we're really, this is really the bread and butter of what we do, and we look forward to continuing to serve Christ's Home moving forward. But just to jump right into it, I think it's always important as we're talking about the economy and the markets to take a step back and sort of see where we've come. And if you look at this chart here, what this is highlighting is global asset class returns. On the left-hand side in red is how they performed during the first almost 3 months of 2020, so the early stages of the pandemic. Where if you look at this chart, most global equity asset classes were down anywhere between 30 and 40%. And this happened in about a 6-week period, which is pretty remarkable how quickly markets fell in that time frame. What's been even just as remarkable is if you think about what has happened since then, as equity markets have significantly recovered, up anywhere between almost 70% and 140% if you look at U.S. small cap stocks, to where we sit today. The S&P 500, which is a measure of U.S. large caps domestic stocks, is around 4,700, near all-time highs. And the S&P is actually up over 20% this year. So it's been a pretty remarkable market recovery since the lows that we saw back in March of last year. When that happens, what we tend to take a step back and look at is what that does to valuations. How expensive are the markets, or how inexpensive are the markets? And what we're highlighting here is a valuation chart meant to highlight global equity markets. So this blue line in the middle would be the long-term fair value where markets should be trading given the level of economic growth and earnings. And the green line is where the actual valuation is at that point in time. So today, you can see that this is above the average fair value. So markets are more expensive than sort of they typically are at any point going back in history. But if we go back to the late 1990s on the left-hand side here on this chart, what we're just highlighting here is that markets have shown that for years, they can actually trade at above average market valuation. So while we've experienced significant returns since the lows in the pandemic, we don't expect double-digit type returns from the equity markets moving forward, but we do still think that mid-single digits are capable of happening, given the fact that we are still in an economic recovery and overall markets in the economy are growing. The reason that markets have recovered as much as they have is really, in our minds, threefold. One, first off, is the progress that has been made from the pandemic. So what we're highlighting here is going back in time when the pandemic started, different trends of COVID-19. So we're showing new case counts in blue, current hospitalizations in green, and then deaths in yellow. And we've seen a couple waves where it spiked. More recently here in the fall of this year, certainly when the Delta variant started to make its way throughout the United States, we did see a spike in cases and hospitalizations and deaths. But more recently, which is positive, we've started to see those numbers roll over. There are still pockets in the US that are seeing rising case counts. There are pockets internationally, like China, that are seeing rising case counts. But at least at this point in time, because of the progress that's been made with the vaccine rollout, the fact that we've seen an uptake there, not just domestically but internationally, we're starting to see these sort of case counts come lower. And while we've seen mask mandates come back in certain industries or certain locations, we certainly haven't seen the appetite from the American public for some of the measures that we saw in April and May of last year. So from our perspective, even if we do see another wave and cases start to move higher, we don't think it's going to crimp economic activity like it did in April and May of last year. Second reason why we've seen markets move materially higher is the amount of fiscal stimulus that the government has provided over the past 18 months and going forward. So even going back to 2020 with the CARES Act, and early this year with the American Rescue Plan, there's been over $4.5 trillion put into the markets by the government to put into the people's pockets who needed it the most, the corporations that needed it the most, the nonprofits that needed it the most, to really try to bridge the gap in lost income or revenues until the pandemic is over. Certainly that's helped markets move materially higher. Certainly today, it's still being discussed in Washington, additional fiscal stimulus measures. Now, earlier this week, President Biden did sign in a new law, the Investment and Jobs Act, which is about a $1.2 trillion bipartisan bill, infrastructure bill, which is going to put about $550 billion in new funding towards transportation, broadband, utilities. And then the Build Back Better plan is still being discussed as well. But if you look at going forward, even if both of those plans come into play, while the level of spending is significant, it's going to be spread out over 8 years. So the level of impact that we saw the past 2 years is not going to be as significant. And so the fiscal tailwind that we've seen that's helped markets, we do think is going to decline moving forward. We've highlighted here sort of what those potential current bills look like. So we have the bipartisan bill listed here in the middle of the page, potential corporate tax implications of those bills being passed, and then certainly the reconciliation bill that's still being discussed. But I think that the takeaway here, if we think about what does this mean for the markets, originally when these infrastructure plans were discussed, there was discussions of corporate tax rates potentially going back to 28%. There was discussions about capital gains rates moving higher, of income tax rates on individuals moving higher. And some of those larger measures, it seems, are not going to go into, completely go into effect. And I know Tom will touch on a little bit of that in his session. But from a market perspective, the fact that the corporate tax rate is not going to go fully up to 28% has actually been a positive for the markets, because if you think about an increasing corporate tax rate, what that does is it lowers earnings for U.S. corporations, and earnings ultimately drive the markets in the long term. So markets have responded positively to the fact that some of the most highly discussed potential tax increases are not fully getting through in the bills that are being discussed today. The third sort of reason why markets have moved to new all-time highs is the significant amount of monetary policy that the Federal Reserve has put into the system. So if you think back to March of last year, the Federal Reserve really went back to their playbook from 2008 and 2009 during the global financial crisis. They lowered interest rates to zero. They reinstituted their bond buying program to keep interest rates low, really with the ultimate goal of encouraging borrowing, encouraging lending in the markets to really help spur economic growth. More recently, the Fed has discussed a removal of those bond purchases. So they have started to taper or purchase less of those bonds starting in November, about $15 billion a month less, to where they will stop that bond buying program in the middle of 2022. So the balance sheet is still expected to go up. They're still being accommodative. They're still providing support. It's just not as much support as we've seen over the past 16 or so months. So really, but the next step in that process is, well, what does the Federal Reserve do from an interest rate perspective to normalize things as the economy continues to move ahead on strong footing? And what we're highlighting here on the right side of this page is projections from the Federal Open Market Committee, or the Federal Reserve, in blue on the path of interest rates, and in green is what the market is expecting. And certainly there's a little bit of a difference here, where the Fed is trying to, and Federal Chairman Powell is trying to put it out there that there's potentially about 1 interest rate increase next year. The markets are expecting about 2 to 3. And that's because they're looking at 2 different measures: one, the unemployment rate and the labor market, and also inflation. And they're really telling 2 different stories at this point in time. From a labor perspective, what we're showing here on the left-hand side is the U.S. unemployment rate. Prior to the pandemic, we can see this rate coming down to below 4%. And certainly this is part of the Fed's mandate. They want to have full employment. They want to keep inflation in that sort of sweet spot of 2 to 3%. But if we look here at the labor market, we still haven't fully recovered from the pandemic, getting back to sort of those pre-pandemic lows. In addition to that, from a labor force participation rate, we also have not gotten back down to pre-pandemic levels. We're about 3 million workers less have rejoined the workforce than were working prior to when the pandemic started. So certainly, if you think about where that comes in, there are two specific areas where we've seen a lack of improvement. One in women caregivers who are either have quit their job during the pandemic to be at home with kids who are going to school from home or taking care of a relative. They have not come back into the labor force in droves yet. And also workers without a college education who might have decided to use the opportunity during the pandemic to go back to school, to increase their skill set and make themselves look better to a potential employer on the other side of schooling. So we've certainly seen the fact that schools have reopened. We expect these trends to improve. The fact that extended unemployment benefits have started to wear off should help these trends, and the fact that vaccination rates are higher and the bulk of the population feels more comfortable going back to work. We still think that there's more room for the labor market to heal. The other thing that the Fed looks at is inflation, and what they're highlighting here, or what we're highlighting here, is the overall U.S. Consumer Price Index, which is one of the Fed's favorite metrics to look at. In 2020, we see the levels of inflation. And if we look back at the first 3 months of the pandemic, we actually saw very low levels of inflation. In fact, we almost saw deflation, where prices were going down. Deflation is pretty bad for economic growth because if consumers believe that prices are going to go down, they tend to delay purchases and wait for cheaper prices. And because consumers make up about 70% of overall U.S. GDP in typical years, that's bad for economic growth. So part of the steps that the Fed took in early 2020 was to fend off deflation. So naturally, coming into 2021, because inflation was so low last year, we were going to see higher than average inflation readings earlier this year. It was just naturally going to happen. But what we've seen more recently is a persistence in this inflation. And we expect that to extend into 2022. And I'm sure, we've all seen this, whether it's at the gas pumps or at the grocery store. We can feel the fact that prices are higher, and that sort of affects the overall consumer behavior. Thinking about why we think inflation is going to extend into 2022, part of the reason is that if you look at this survey by the Federal Reserve Bank of Dallas, which polls CEOs on what's restraining overall firm revenues from being even stronger than they are. Last year, overwhelmingly, the response was that there was weak demand, which makes sense. People were staying home. We were fearful. We're not purchasing as much. So the demand kind of fell last year, and that caused actually a disinflationary type of environment. Fast forward to this year, all that pent-up demand is coming back on the markets. People want to go back out. They want to travel. They want to purchase the things they didn't purchase last year. So actually, demand has significantly outstripped the overall supply. So if you look at overall what that's caused is that a lot of the respondents have said that supply chain disruptions or limited staffing is actually affecting them from selling more goods or from revenues from being higher. A few of the things that we are sort of looking at, if you just look back to summer months, some of the things that happened this year is a lot of people were home. So there was a significant amount of home improvements and home building going on. We saw lumber prices spike well over 100% when that happened because of the supply-demand imbalance. We saw used car prices and rental car prices spike because of the shortage in semiconductor chips coming out of Asian countries, as they didn't make as many chips last year when there were those lockdown measures put in place. But from a positive perspective, when we look at overall container ships in an example like the Port of LA, which is a very important trading venue for the United States from goods coming in from other countries, we've started to see the backlog coming down in overall container ships. And we've seen that lagged case counts from COVID-19 by about 6 weeks. And because case counts are coming down and people are going back to work, we've seen, the hope is that those container ships start to get their goods spread out in the US and the supply-demand imbalance starts to right itself. In addition, in areas like Asian countries like Vietnam, where we actually import a lot of goods, we've started to see vaccination rates get up to levels similar to that of the US, to where we hope that the supply chain continues to heal moving forward. But this is certainly something that we're monitoring, because think about one of the things that can choke off an economic recovery, and has in the past, it's when the Federal Reserve makes a misstep. When they either raise rates too early, too fast, responding to inflation, or they let the economy run too hot, too long, and they raise rates too slow. When they make a misstep, that's tended to cause economic recoveries to be maybe shorter than they otherwise would have. So we are watching this very closely. But if we look about growth going ahead, thinking on this chart here, what we're showing is US GDP growth projections in 2021 and 2022. So expectations for about mid-single digit types of GDP growth, which is pretty significant. If you look back to what happened post the global financial crisis, we were seeing levels of about 1.5% to 2.5%. So the fact that we're seeing mid-single digits, we think is positive. And again, the economy still has room to grow moving forward. From an earnings perspective, which again, as I mentioned earlier, is what drives ultimate market growth in the long term. What we're highlighting here is going back to pre-2000 and earnings growth over time in the blue bars. And then the gray bars show the last 3 recessions. So we see the dot-com bubble in 2001, the global financial crisis here in 2008, 2009, and then the pandemic-led recession here recently. And this makes sense. What tends to happen after you see a significant drop in earnings is that you have a significant rebound in earnings. So we've gotten to a point where we think that we have peaked in earnings growth. But that doesn't mean that earnings will not continue to grow mid-single digits going forward from here. So there's this narrative out there in the markets that because we've hit peak growth that the markets could fall moving forward. But if you look at sort of the overall post-peak growth returns from 2002 and 2010, 3 years out in 2002, the S&P 500 was up 60%, and 5 years out after 2002, the S&P was up over 100%. Similar story here after the global financial crisis. So while markets have come a long way, we do still expect to continue to be positive moving forward, which should help market growth. With that being said, it's been a one-way market since March. We saw a 5% pullback in the equity markets in September, but traditionally, we see about a 10% pullback every 12 to 15 months. What this chart is highlighting in the blue bars is overall S&P 500 returns every year going back from 1985 through this year. And the yellow dot at the bottom is that intra-year peak to trough decline. And we see a lot of negative 8%, 10% in here. So to my point, there is typically every year about an 8 to 10% type of pullback. So would it surprise us if we saw a 10% pullback in the markets in the next few quarters? No, it would not. Are we predicting it? No, we're not either. But I think it's important to highlight that even if you do see that type of pullback, even if you go back here to this year the markets pulled back 16% during the year. It doesn't mean that the markets are going to be down that year. That year, the S&P 500 actually finished up 13%. Last year, we had a peak to trough decline of 34% from February to March. The S&P 500 finished up last year 16%. So in our minds, if we were to see a pullback, that can actually be healthy. It kind of resets market expectations. Investors who were on the sidelines have the time to get back in, and then markets can kind of reset and move higher from there. So I just want to sort of point out that at some point there is going to be a pullback, but it does not necessarily mean that that's going to be another recession. My last comment is I just want to talk about our expectations moving forward for returns across markets. So what we're highlighting here in the light colored bars is historical 10-year returns by asset class, both in fixed income, in the brown and gray bars on the left, and in equities in the blue and light blue bars on the right. just to focus on two of them, what this is saying is that historically, we've experienced about a 4.5% from your core investment grade U.S. Think about U.S. investment grade fixed income over the past 10-year type of return time periods. Going forward, our expectations from this area of the portfolio or of your portfolio are for only about 2% per year, just given the fact that we're in a very low interest rate environment. We do expect interest rates to rise over time, which is a headwind for fixed income returns. But just be mindful that we're at a higher starting point for valuations, both in fixed income and equities as well. So just looking at large caps for a second, what this is saying is that historically, U.S. large cap returns were about 9% per year over a 10-year period. But going forward, we're only expecting about 5%, again, because we are at a higher starting point for valuations. So what does this mean? It means that it's more important than ever to have a diversified portfolio so that you always have a portion of your portfolio doing well, even if some of those blue chip U.S. large cap stocks that have really done well in the past don't do as well in the future. Over time, maybe not in the short run, we do expect international markets to still do a little bit better. They're about 3 to 4 years behind the U.S. from an economic recovery perspective. They're still quarters behind the U.S. from a getting out of the pandemic perspective, because their central banks and their governments could not provide as much stimulus as the U.S. did. So, we do think that mid-single digit types of returns are possible moving forward, but expectations should be muted. So I'll pause there for a minute. That kind of concludes my prepared remarks, but I'm happy to answer any questions or turn it over to Vernon and George for the next portion of the meeting.
Yeah, if you have any questions, you can unmute and ask Tom and Steve. We do have a few questions coming in. If there aren't any questions, the one that we do have is, are there any recent changes to charitable deductions that our viewers should know about?
I'm going to cover that in our discussion about year-end planning. Okay. So before we dive into that, George, I think it would be, I just want to make sure that we're putting a bow around Steve's portion of the meeting if there are any questions about the economy and the markets.
Yeah, one thing, I didn't know if somebody was chatting in there, George, or not, which is great if they choose that. I think one thing, and you can tell me if this is relevant or not, Steve, do you have any idea as to how much of the, I think you said $4.4 billion or $1 trillion in stimulus is still kind of sitting on the side as opposed to having been spent, and what might be the impact going forward as that gets used?
Sure, no, great question, Vernon. I mean, certainly consumer and company balance sheets are actually in a much better place than they were prior to the pandemic, to your point, because there was a lot of funds given out that weren't necessarily immediately spent in the economy. So there is still, I think, pent-up demand. And at this point in time, part of the reason why we're seeing inflation move higher is because there is that demand, but there's not enough supply to meet it. So we do still think that is a leg to help propel the economy moving forward. To get to the specific levels that have not been spent, I haven't seen a percentage of that overall 4.5 trillion. But even just going back to, from a consumer perspective, taking corporations out, I have seen figures where it looked as if consumers were holding back about a third of overall money coming into them to try to basically either pay down debt, put it in savings, put it in the markets, and not putting it in the economy as markets continue to move higher. So there's definitely still pent up demand, and I think that consumers want to spend money. They feel good about their prospects with markets where they are. Certainly Main Street has not fully recovered as well as Wall Street has, to your point in the beginning. And there's still pockets of the economy that need help and need time to repair. But we've come a long way since the start of the pandemic.
I know sometimes that's a complaint of some politicians is why are we trying to get more when we haven't spent what we've already approved? So time will tell what happens there. So last call for questions. Otherwise, we're going to go to Tom, have Tom introduce himself and his role at Glenmede, and then George has a few questions that he wants to throw at you. All right, Tom.
Well, no, it's thanks, Vernon. It's really a pleasure to be with you today, and thank you for having us. We always enjoy these programs with the team at Christ Home. So as Vernon mentioned, my name is Tom Moore. I'm also part of the dedicated endowment and foundation team at Glenmede. Steve and I are actually partners on our team, and we work together alongside with Vernon and the team at Christ Home on the Christ Home relationship. So in my world at Glenmede, what I'm responsible for are the day-to-day administrative aspects of our accounts. I do have a background in nonprofit fundraising and law, and in working with gift planning and things along those lines. So what I try to do in my role is bring those experiences to bear to help our clients, help achieve their missions. So, that's a good segue into our discussion here. We're talking about some changes in the law as it relates to giving and things that might be relevant for us to consider as we approach year end, which is always that magical time in the philanthropic world, because it's the end of our tax year as individual taxpayers. But as we dive into this, I think it's important to remember that the things that I'm going to be talking about are really relevant all year long, right? And so philanthropy is an ongoing dialogue. And so, if anything that I talk about really, strikes an interest in you, please reach out to Vernon and his team to have that conversation. And that's not just between now and December 31st, but all year long. So with that, hi, it's nice to be with you, and I think we can dive in.
Okay, we also have Christ Home is seeing an increase in gifts of appreciated stock. Can you share your thoughts on the benefits of donating stock versus cash?
Yeah, I'd like to start with the bigger picture question about changes to the charitable deduction that you asked earlier, George, that I kind of sidestepped for a minute. So if we can go back to that, let me answer that question first, if I may. From that standpoint, I really want to highlight two significant changes that took place as a result of two different pieces of legislation, and we've talked about this before, but it's still relevant to our discussion today. One is the Tax Cuts and Jobs Act of 2017, and that made significant changes to the tax code for individual taxpayers. And significantly, it nearly doubled the standard deduction to about $12,000 for individuals and $24,000 for married couples, and it eliminated most of those personal exemptions. The charitable deduction, however, remains intact, and in fact, the limit on charitable deductions was raised to 60% of our adjusted gross income. But by doubling the standard deduction and eliminating most personal exemptions, there are fewer people that take advantage of that. The opportunity that creates, though, for people who do itemize their deductions and can do so and can afford to do so, is to consider a concept called bunching or bundling. And essentially what you do is you front load your giving, and you do so in a way that helps you maximize your tax savings. So the idea is, in year one, you bunch or you bundle multiple years worth of giving into a single year, or accelerate what you might otherwise be doing for a charity. And you take your itemized deduction, and then in subsequent years, years 2, 3, 4, 5, whatever the case may be, you claim the standard deduction. And so the idea there is, over time, you're paying less in tax and getting the most bang for your charitable buck, if you will. And so if that works for you, it's something to talk about with your financial and tax advisors. It's something to talk about with Vernon and his team. Maybe something like that works for you. but it's, we're seeing that with increased frequency. The second act or statute that I want to talk about is the CARES Act of 2020, which Steve also mentioned. And very significantly, this act came into being as a way to encourage giving in the wake of COVID-19, right? Because of charities that were suffering. So significantly, for people who itemize their deductions, you can deduct up to 100% of your adjusted gross income. Remember, I said it was 60. For 2020 and 2021 only, you can deduct up to 100% of your adjusted gross income for cash gifts to public charities like Christ's Home. So, I talked about the bunching or the bundling. Well, this might be part of that idea, but this is a really big deal. So if people can afford to do so, for this year, they can give up to 100% of their adjusted gross income. For people who do not itemize, there is that $300 above the line deduction for charitable gifts, or $600 for married filing jointly taxpayers. That's an above the line deduction. So again, if you've not taken advantage of those, now is a good time to do that, because we're nearing the end of the tax year. George, are there any other questions to talk?
Oh, there was the gift on, or the concept of stock giving versus cash.
Yeah, let's talk about that. So giving appreciated property in lieu of cash is an easy thing to do, and it's often overlooked. And with the dramatic market gains that we've seen since March of 2020 that Steve has so ably highlighted, there are many people out there that have portfolios with, sitting on lots of unrealized gain. And so the idea here is to give the gain away and avoid the capital gains tax altogether. And that's regardless of whether the rates go up, as we see might be a possibility. So giving out of our checkbook, right? Giving out of the cash that we have is fine. And most of us do it, and it's all well and good, and it's wonderful. But maybe there's a more efficient way for you to give to Christ's Home and the other charities that you care about. So if you have appreciated stock and you sell it, you're going to pay income tax on the capital gain, currently as high as about 20% if you've held that for more than a year, or your highest marginal rate if it's short-term property that you've held for less than a year. So instead of selling that property and then having cash that you give away, why not give away the property itself? So to Christ's Home, $10,000 worth of Apple stock is the same as $10,000 worth of cash, right? Because they're going to sell the stock and then they're going to use the cash for whatever charitable purposes are designated. But as a donor, you can avoid paying the tax on the sale of that Apple stock by giving the stock directly. And this idea is not just limited to stock. It can be used in a business interest. It could be used with real estate, artwork, other types of assets. And it can also be used for things like life income gifts, like charitable gift annuities or charitable trusts. In that case, you can mitigate the capital gains tax consequences, but not necessarily avoid them altogether, but you'd mitigate them to a degree. So there's lots of possibilities with appreciated property. And the message that I'd like to leave there is, if you think that this applies to you, talk to your advisor, talk to your accountant or lawyer, and certainly talk to Vernon and his team.
All right, Tom, thank you.
Just let me follow up just to make sure here, George, too. Tom, in addition to avoiding the capital gains tax, if they are itemizers and giving over that standardized deduction, that $10,000 of Apple stock is a tax deductible gift to Christ's Home. They would get a receipt from us. So potentially, especially if they're doing bunching or something like you're referring to, that it could increase their actual tax deduction in that given year. Does that sound right?
That is correct, and they're getting a deduction based on the market value of the Apple stock, not their cost basis in the Apple stock. So you're correct.
Sorry, George. Go ahead.
Do you see any change coming in interest rates that would help individuals increase their income?
Changes in interest rates, maybe not, but there are opportunities. As Steve mentioned, interest rates are at historic lows, and we do expect them to go up modestly, but they are likely to remain very low for a long period of time. And so there are lots of folks who are banking on income production from their assets who are disappointed, and they've probably been disappointed for a while. So one thing to consider is what's called a life income gift or a split interest gift in a gift annuity, a charitable gift annuity, or a charitable remainder trust. Now, we just talked about giving the gain away with gifts of appreciated assets. So, you can utilize that concept here as well. But generally speaking, if you hold cash or you hold securities, the income that you're going to generate off of those assets is really based on whatever the prevailing interest rate might be, or if it's stock, the dividends that are declared by Coca-Cola or AT&T or IBM or whatever you're holding, right? And so we're experiencing really historically low interest rates. Instead, if you create a gift annuity or a charitable remainder trust, you get a payout based on a fixed percentage of the value of the asset that you contribute. Or if you create something called a charitable remainder uni trust, you can get a fixed percentage of the trust's market value, which is adjusted annually. So I do know, based on my conversations with George and with Vernon, that Christ Home offers gift annuities. So I invite you to think about whether or not it's something appropriate for you to do. So let me give you a quick example, okay? With a gift annuity, if you use rates set by the American Council on Gift Annuities, which I have confirmed with Vernon that Christ Home uses, a 73-year-old who purchases a single life annuity, a gift annuity, would receive an annuity payment of 5.1% of the value of the assets that they transfer. So to make this easy math, because I'm math challenged, a hypothetical donor who gives, let's say, $100,000 worth of stock, they would get $5,100 annually every year for the rest of their lifetime. They'd get that paid out over their lifetime, and then whatever's left in the annuity at their death passes to Christ Home to be used for whatever purposes you've designated with Christ Home. Now, depending on the asset that you've transferred, and here's why it's important, depending on the asset that you transfer, that $5,100 could be significantly higher than whatever income you're earning off of that $100,000 worth of stock or cash, right? So it depends on the assets that you're looking at, but it's an opportunity to get a charitable deduction for the present value of that charitable remainder. You get the satisfaction of supporting Christ's Home, but you can also, depending on the asset, significantly increase your income, which you might need. So it's a neat tool. With a charitable remainder trust, it works kind of the same way. You could get either that fixed annuity payment of the assets in the trust or a fixed percentage of the market value of the trust, which would be adjusted annually. So the added benefit about giving the gain away is that if you have appreciated stock or appreciated assets that you use, when the gift annuity or the trust sells those assets, you would mitigate your capital gains consequences because you would get your capital gain reported out to you in pieces over time rather than all at once if you sold it yourself. So it's a really nifty planning tool that could get you more income, that could mitigate some tax consequences. But what's important about it is you should think about it, and if you think it might apply to you, give Vernon a call.
Tom, thank you. We're also seeing more people making gifts to Christ Home from their IRAs. Is this a good practice for charitable giving?
In a word, yes. And IRAs are really important assets to consider in the context of a complete and comprehensive estate and philanthropic plan. And for many people, their IRA is among their largest financial assets, but it passes pursuant to a beneficiary designation, not a will, not a trust agreement. and there are default provisions built into whatever plan you're part of. So it's often easy to overlook and not fully consider it. And the Secure Act of 2019 made some really significant changes to IRAs that we should think about and discuss with our advisors. Really importantly, what's called the stretch IRA was eliminated in the statute, in the Secure Act. And so previously, the law allowed spousal beneficiaries, spouses can take their deceased spouse's IRA and roll it over into their own, right? We all know that. But for non-spousal beneficiaries like kids or friends or other relatives, the law previously allowed that beneficiary to continue growing the assets inside the IRA tax-free and permitted them to withdraw based on an extended life expectancy or many years, even their own life expectancy. So that's been eliminated. So now, with very limited exceptions, a non-spouse beneficiary has to withdraw the entire amount of the IRA within 10 years of the IRA owner's death. So that's going to result in a lot of deferred income tax due over a relatively short period of time, and it's likely to seriously erode the value of the IRA. So the planning opportunity here is that IRA owners might consider leaving other assets that are more tax efficient to their non-spouse heirs, and instead name Christ Home or other charities as the beneficiary of the IRA. And that way, 100 cents on the dollar on the date of death will go to charity, right? The other piece with IRAs is that the qualified charitable distribution, also known as the IRA charitable rollover, is permanent. And so the way this works, and this is a great tool, IRA owners who are 70 and a half or older can make up to $100,000 in direct charitable contributions annually from their IRAs to charities like Christ Home, right? You don't get a charitable deduction for doing it, but those distributions count towards your RMD, and they're excluded from income, so they're not taxed in the first place. So if there are donors, or if there are people who have large IRAs who take their full RMD each year only because they have to, right? They might use some or all of that $100,000 qualified charitable distribution to support charities like Christ Home instead. It's a win-win, right? And it would also help reduce the value of the IRA and possibly mitigate some of the tax consequences that I just talked about, at death, to the extent that you give up to 100% of your adjusted gross income. Some folks will actually take they'll do the qualified charitable distribution and then also take RMD and pull that into income and also pay that out, because this year you could give up to 100% of your adjusted gross income. So that's another way to leverage your IRA. So the bottom line is, work with your advisors and crunch the numbers, but also, give the development team a call if you think that this applies to you.
All right, Tom, thank you. We have one more question. What about all the discussion or chatter around possible changes to tax rates and the estate tax a matter of concern?
Yeah, there are lots of proposals floating around Capitol Hill right now as part of the Build Back Better reconciliation bill. And at this point, as of today, no legislation has passed either the House or the Senate. And so with all of those proposals floating around, it's really easy to get distracted by what I call, all of that noise. But a lot of the tried and true planning strategies that we've just discussed, they remain as relevant as ever. And in fact, because today's environment is such a low rate environment, they're even more relevant than they've been in the past. And they will be even more relevant still if some of those proposed changes go into, are made into law, right? So everything that we've discussed is relevant, and it's just a question of how relevant it is. But so here's what we know, right? The idea of giving the gain away, even if the capital gains tax rates do not go up, as we've discussed, We've still seen the historic market gains since March of 2020. So the things that I discussed earlier around giving appreciated assets, whether outright or part of that life income gift, like a gift annuity, they're still important to consider. But if the gains rate, capital gains rates do increase, then everything I just said is still true, but the consequences of the capital gains tax are more significant. So everything that I just said is more true. I don't know if there's gradations of truth, but just work with me on that. So that's as it relates to giving the gain away. For life income gifts, again, interest rates are at historic lows, and although they might be increasing in the next couple years, you know, they're likely to remain low. So regardless of what happens on Capitol Hill, donors should consider whether a gift annuity or a charitable trust might make sense. An important thing to talk about, George, which I've not yet, is the estate tax. So the current for the estate tax is $11.7 million per person. The current draft of the reconciliation bill does not change that exclusion amount to of $11.7 million, though it's possible it might. But regardless of whether that exemption amount changes, the current law that enables that $11.7 million exemption, that law sunsets on January 1st of 2026. So unless other legislation passes Congress that's signed by the president that extends that $11.7 million, the bottom line is the law is going to sunset back to what the exemption amount was prior to the Tax Cuts and Jobs Act of 2017, which will be about $5.4 or $5.5 million per person, adjusted for inflation, maybe around $6 million per person. So even if nothing's lowered now, we're almost certain that the current exemption amount is going to sunset back to the $6 million figure roughly in 2026. So what does that mean? We expect that taxpayers that have estate tax planning needs can can afford to do so have or will be or certainly should be talking with their advisors about how to fully utilize their estate tax exemptions now. So what that means is that they will give away the maximum amount that they can now in trusts or however they wish to give it, away to their kids and so forth. Do it now and fully utilize their exemptions now while they're on the higher side, right? What that means is that in order to plan efficiently for taxes, estate taxes, that legacy giving in wills and trust agreements, retirement plans, and life insurance policies becomes all the more important, right? Because now you want to, save on taxes. So it's of course in addition to all of the non-tax reasons why people give as part of a legacy plan. So again, what I strongly encourage is that people have these discussions with their tax and legal and financial advisors and with Christ Home.
Good, thank you. We have one more question for today. And that question is, what else should our donors do or be considering as we move toward year end?
Yeah, that's a good question, George. And I think it's, let's take a step back, right? For the last 15 or 20 minutes or so, I've thrown a lot of information out there, some of which is rather dense and technical, right? So I think it's important for folks to take that step back and realize that nothing that I just discussed should happen in a vacuum, right? It all happens in the context of a comprehensive estate and financial plan, and hopefully one in which philanthropy and charitable giving is fully and thoughtfully considered, right? So I'm in the philanthropy business, so it's natural for me to say that I strongly encourage the audience to support their favorite charities like Christ Home as much as they can. These are challenging times, and we know that wonderful organizations like Christ Home need as much support as they can get. I mean, that's a given, but I think it goes deeper than that, right? It's always a good time, especially this time of year as we approach year end, and especially now as we approach Thanksgiving, right? It's important to think about what's important to us and why we support organizations like Christ's Home and what Christ's Home means to us. And so with that as a backdrop, I really do think, thinking about legacy giving is important. It's a vital tool. So I do strongly encourage people to consider a bequest or naming Christ's Home as the beneficiary of an IRA or life insurance policy, or some of the strategies that we talked about with respect to, gifts of appreciated securities that might be significant in nature, or charitable remainder trusts or charitable gift annuities or so forth. But with legacy giving, as opposed to, the sort of that checkbook kind of giving, you really can have a significant impact on Christ's Home long after you're gone. And better yet, by having that dialogue, you get to work with great people like Vernon to help plan now for exactly how that legacy will be implemented. And Steve talked about our role at Glenmede in terms of working with the Christ's Home team to invest the assets with that long time horizon, so that years from now we're still being able to provide meaningful support to the operations of Christ's Home in excess of what we're spending today, and in excess of inflation. Part of that's enabled because of giving at the end of the day. So really, to put a bow on everything that I've just said, I think if you strip away all of the technical stuff about taxes and assets and things along that line, it really just starts with a good, thorough conversation about what's important to us and why. And then, so as we approach year end, I encourage people to give that some thought and to start that dialogue or continue that dialogue.
Steve, Tom, thank you. Vernon, any closing thoughts?
Yeah,
Comments?
absolutely. Want to thank you, men, and certainly appreciate the thoughtful approach to that, Tom, and talking with advisors, talking with family members and whatnot. On a few occasions over the years, I've had to recommend to someone that they not make a gift because of their financial situation. And we have to be good stewards. We need to be fair and honest. It's really important that we're not only focused on the money, we're focused on the people who certainly live at Christ's Home, and those who are our friends and want to do what's right by them. I want to thank both Tom and Steve for participating today. Thanks so much. You guys look great. Ties, coats. Oh man, we got the top end treatment here today, and I appreciate that. This for those of you who are listening, this is a service that they provide to Christ's Home. We didn't pay for this. They get their fees for helping us and based on how our portfolio does, but this is a service that they make available not just to us, but to other nonprofits that they work with as well. And I'm proud to say and happy to pass on to our listeners here that Glenmede is an annual sponsor of Christ's Home. They've been doing it for probably, well, I think since their first year. So they make a contribution to Christ's Home annually. And it's one of the higher levels available. So we thank you for that. George, thanks for hosting today and for recording it. We will, he'll be having this edited as need be, and then get a link out. So we'll make sure that you folks get it, as well as other folks who were unable to attend today who are interested in the information. Sorry that I disappeared there for a little bit. I don't know what truck hit our pole out here, but I was down on the internet for whatever it was, 6 minutes or so. And so lastly, thanks for joining us today. And to each and every one of you, I wish you a happy Thanksgiving. Thanks again for coming in.
Thanks for having us. It was
Thanks,
a pleasure.
everyone.
Be well.
Thank you.
Thank you.
Bye-bye.
Thanks. Bye now.